Gold crossing above the $4,200 mark isn't just another chart movement, it's a signal, and one that many people still aren't fully appreciating. That number on the screen is less a price and more a warning flare. Anyone assuming this is just another routine upswing in the metals market may be overlooking what could become one of the most significant wealth reallocations in recent decades. Here's the part people rarely acknowledge. Central banks worldwide appear to be accumulating gold at volumes we haven't seen in modern history, reportedly close to 1,000 tons per year, and not for a short stretch, but for about 3 consecutive years. When major financial leaders hint at dramatic price potential, some suggesting figures in the 5-digit range, it isn't meant as hype. Rather, it reflects a growing belief that trust in traditional currency structures may be weakening, and gold serves as a hedge against that erosion. But this story intensified in early December. On the first of the month, something subtle but crucial happened. The Federal Reserve effectively wrapped up its phase of quantitative tightening. That means they stopped shrinking the money supply. Then, just days later, indications pointed toward another rate cut. These aren't trivial moves. They're signals that economic stress is rising beneath the surface. While policymakers were focused on containing inflation, the job market quietly took a hit. Roughly 32,000 private sector positions disappeared in a single month, the sharpest decline in over 2 years. Smaller businesses are struggling, wages are stagnating, consumers are pulling back, and Federal Reserve officials know it. When the president of the New York Fed says there is room to lower rates, it isn't casual commentary. It suggests deeper concerns about economic momentum. As always, this analysis is for educational purposes only, not financial advice. But let's shift back to what gold's movement is actually telling us. This isn't simple price speculation. This resembles a phenomenon I call a trust reversal. Consider the US dollar index, which recently slipped below the 100 level. That number carries psychological weight. Back in the late 1990s, the dollar accounted for roughly 70% of global foreign reserves. Today, that share has reportedly dropped to around 58%. The decline isn't catastrophic by itself, but the direction's unmistakable. Where is that lost reserve share flowing? Increasingly into physical gold. Countries like Kazakhstan are accumulating at record paces. Nations such as Brazil have reportedly returned to purchasing after long pauses. Poland has publicly discussed pushing its gold reserves to around 30%. Moves like these aren't casual investments, they're strategic buffers. What's even more striking is a recent analytical claim for the first time since the mid-1990s. Central banks may now hold more wealth in gold than in U.S. Treasury bonds. Think about that. More value stored in metal than in American government debt instruments. That shift isn't just financial, it's structural, and it's happening quietly. If this feels familiar, it's because patterns like this have emerged before few saw them coming, and those who ignored the signs often paid the price. History has shown that whenever trust in financial systems weakens, gold becomes the fallback asset. And this isn't the first time the world has seen a pattern like the one unfolding now. In fact, it has happened repeatedly, 3 major times in the last century, and each cycle reshaped the global financial landscape. Those who anticipated the shift protected their wealth. Those who dismissed the warning signs often didn't. Take 1933, for example. The United States was struggling in a deep economic downturn. Banks were collapsing, unemployment was immense, and public confidence was evaporating. The government responded with an extraordinary action, a mandate requiring citizens to turn in their gold at a fixed rate, roughly $20 per ounce at the time. And after controlling the supply, the government revalued it upward to around $35. That adjustment amounted to roughly a 40% devaluation of the dollar overnight. Personal savings lost buying power instantly. Gold became the lever through which the system was stabilized, and everyday people bore the cost. Fast forward to August 1971. The global monetary system was already under strain. Foreign governments, particularly those skeptical of America's ability to redeem dollars for gold, began requesting physical delivery. Pressure intensified when one major nation sent a naval vessel to collect its gold allocation. The U.S. responded decisively. President Nixon suspended the dollar's convertibility into gold. With one televised announcement, the Bretton Woods system effectively ended. What followed was a decade of inflation, oil shocks, economic stagnation, and a dollar losing ground. Meanwhile, gold surged from about $35 to over $800 by decade's end. Those watching the trend secured their purchasing power. Those who didn't struggled with the aftermath. Then came 2008. The collapse of major financial institutions rattled markets globally. Lehman Brothers failed, Bear Stearns disappeared almost overnight, insurance giant AIG required emergency intervention, and central banks responded by injecting trillions of new dollars into the system. Gold once again acted as a shield, rising from the $700 range to nearly $1,900 within a few years. Not because of hype, but because when trust weakens, tangible assets tend to gain favor. Now look at December 2025. The pattern is resurfacing. U.S. debt has crossed $36 trillion, with a substantial portion of that total coming due within the next decade. That means policymakers face 2 options: retire the debt or refinance it. Since paying it off in full is unrealistic, refinancing becomes the default. But here's the catch. Interest rates climbed rapidly from near zero levels to around 5%. That surge makes debt servicing a heavy burden. consuming an increasingly large share of the federal budget. This situation limits the government's flexibility, and it likely explains why the Fed appears inclined to cut rates again, not because growth is booming, but because the debt structure itself is becoming more difficult to sustain. If rates stay high, the system faces pressure. If rates fall too quickly, inflation may return. Either option signals instability, and gold reacts accordingly. What's different now is that the stress isn't isolated to the United States. Global institutions are openly discussing a fundamental restructuring of the economic framework that has shaped the world for 80 years. Not a tweak, not a revision, a restructuring. And in times like that, nations prepare by strengthening their reserves, especially in assets they can trust. As the global system shows signs of strain, countries are taking strategic steps that speak louder than official statements. Several major economies have reportedly increased their gold reserves while reducing exposure to U.S. debt. China hasn't publicly disclosed full reserve details in years. Russia has significantly trimmed its treasury holdings while expanding gold positions. Saudi Arabia has begun engaging in oil transactions using non-dollar currencies, an early indication that the long-standing petrodollar arrangement may be weakening. When a structure that's held for 50 years starts showing cracks, nations don't wait for announcements, they reposition quietly. Why does this matter? Because gold represents continuity. Currencies rise and fall, alliances shift, policies change, yet gold has maintained trust for thousands of years. When countries prepare for uncertain transitions, they increase holdings in assets that don't rely on anyone else's promises. Even the technical patterns in gold's price reflect this tension. Recently, the metal attempted to break above the 4,250 level several times, but couldn't sustain the push. It dipped toward the low 4,100s where buying support appeared. Now it's consolidating, building pressure. Analysts note that if gold falls below roughly 4,085, further pullbacks could develop. But if it breaks through 4,250 with conviction, the next move might carry it toward 5,000. Beyond that, the chart shows very little historical resistance. Once sentiment shifts from "is this price too high" to "how far can this run," markets can accelerate rapidly. Silver adds another dimension to the story. It recently surged toward the high 50s, nearly doubling this year. Silver is often seen as gold's counterpart, and when it outpaces gold, it can indicate rising industrial demand as well as growing preference for tangible assets overall. In times when paper assets feel uncertain, people often diversify into not just gold, but a range of physical commodities. Forecasts from global research organizations reflect this momentum. Some projections suggest gold could climb another 15–30% in 2026, which would place it somewhere between 4,800 and 5,500 in moderate scenarios. More aggressive forecasts, set under conditions of heightened geopolitical tension or accelerated central bank demand, mention figures above 6,000, 10,000, or even higher. A few long-term theoretical models explore extreme cases where gold's price is recalculated to reflect national debt coverage, producing numbers that sound implausible until you examine the math. Consider this. The U.S. still officially lists gold reserves at a valuation set decades ago. If the government ever chose to revalue gold to reinforce confidence during a crisis, the theoretical calculation, dividing national debt by reported gold holdings, produces figures that stretch into six-digit territory per ounce. Analysts debate whether the full gold supply at major vaults has been independently verified in recent decades, noting that the last complete public audit occurred many decades ago. While this doesn't imply anything is missing, the lack of updated confirmation leaves space for speculation. Hearing numbers like 10,000 or 38,000 per ounce naturally prompts skepticism. Most people reject dramatic price projections because they seem exaggerated. But history shows that each time gold made a steep upward move, the majority doubted it beforehand. In the early 1970s, few believed gold could reach $100. In the 2000s, many dismissed the idea of gold hitting $1,000. More recently, people doubted it would cross $2,000. And yet, each milestone eventually became reality. The common thread? Gold doesn't rally from enthusiasm alone. It often moves when underlying trust in monetary systems weakens. So what comes next? A likely scenario based on current signals is that the Federal Reserve continues cautiously adjusting rates, potentially lowering them again, as hinted for December 10th. A reduction of even a quarter point could act as fuel for gold, especially if it pushes the price decisively above the 4,250 resistance level. Should momentum carry it into the 5,000 range, the psychological landscape of the market shifts. At that point, the question typically stops being, is gold overpriced, and becomes, where is the ceiling? That shift in perspective is what historically leads to accelerated moves. But this doesn't necessarily mean the Fed is embarking on a long-term easing cycle. More likely, this appears to be a tactical move, an attempt to support a weakening labor market without triggering runaway inflation. It's a delicate balance. If the Fed cuts too aggressively, inflation could return with force. If it holds rates too high, unemployment may rise. In either case, gold tends to benefit. One scenario strengthens the inflation hedge narrative, the other boosts recession hedge behavior. This is precisely why central banks continue to accumulate metal. It's why wealthy individuals diversify into hard assets, and it's why ordinary people are paying more attention than ever. The conversation is shifting beyond traditional finance. Discussions about currency instability, gold surge, and shifting global power structures are spreading across social platforms. Commentators refer to this moment as a trust shock web period, when confidence in established financial systems begins to erode. Some view gold's rise as an early warning of a deeper currency realignment. Others connect the trend to digital assets, arguing that if capital begins fleeing fiat currencies, it may first flow to gold, then eventually into decentralized alternatives. Some predict dramatic future valuations for assets like Bitcoin, framing it as the final stage of a potential monetary reset. Whether one agrees with that or not, the narrative itself reveals something important. People sense instability. They're searching for reliable stores of value. Here's the part most analysts overlook. This isn't just about making gains, it's about protecting what you already have. If the dollar loses another chunk of its purchasing power, your savings, wages, and retirement all shrink unless you've hedged against that erosion. Throughout history, gold has functioned as that hedge. Not because it promises income or growth, but because it carries no counterparty risk. It doesn't rely on corporate earnings or government policies. It simply exists as a universal store of confidence. And here's the key perspective. If you wait for absolute confirmation before acting, the move might already be over by the time you decide. By the time the reset becomes obvious, gold could already be far beyond current levels. Institutional investors aren't waiting. Central banks aren't waiting. Many individuals aren't waiting either, because moments like this, rare, unstable, transitional, are when wealth quietly shifts. But there's a positive side many overlook. Periods of transition also bring opportunity. In 1933, those who positioned correctly were protected. In 1971, early movers benefited enormously. In 2008, those who hedged preserved their wealth. And now, with similar signals emerging, individuals today have the chance to prepare rather than react. So as the world changes, and it clearly is changing, the question becomes simple. Will you observe the shift or prepare for it? Gold passing $4,200 isn't merely a statistic, it's a message. The system is signaling stress, and gold is responding exactly as it has for thousands of years, by revealing the truth beneath the surface.